The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A stock market sputter kicks off an otherwise quiet week on Wall Street. Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Isabel Lee. We're kicking you off to the closing bell in the U.S., Scarlett. It's Monday again.
It's Monday again. It's mid-August. It's fairly quiet. Nevertheless, stocks and bonds are falling, oil rising on renewed geopolitical tensions. The S&P 500 down for a second day after last week's record high. Even so, chip makers are higher for a fourth day in 5. WTI is now at the highest level this month, so a reminder that inflationary pressures persist, and that is helping put pressure on bonds, especially at the long end of the yield curve. The 30-year yield highest since 2007. That is before the great financial crisis, Isabel.
And let's take a look at some of the day's biggest movers, because even if it's quiet, there is some movement under the hood. So Centene, this is a health insurer. You see the shares there down after the company reported its CFO, Drew Asher, plans to retire at the end of 2027. So you see the stock there down by nearly 5%. And next up, JetBlue Airways. Shares also dropping, down by more than 6% after Seaport Global cut its recommendation to neutral from buy. The analyst there, Daniel McKenzie, saying the balance sheet risk moves to the front burner without the Strait of Hormuz opening. And finally, Shopify. Shares are also in the red. I should have just said it's a sea of red there, Scarlett, because the Phillips Securities downgraded the e-commerce platform with a price target now at around 170 from 180. So definitely big losers there, Scarlett.
All right, Shopify, enterprise software company. Let's just talk a little bit about what it looks like in the tech space. I remember a time when if investors talked about rotation, it was usually between different sectors. But tech is so big now that we get rotations within the industry.
Oh, yeah.
This chart goes back to the start of July. You can see a lot of blue bars to the downside. That represents one-day declines in chip stocks. Sometimes there's white bars moving up. That's one-day gains in software stocks. For today, if you look at the far right of the chart, and we're getting there, what you'll see is a blue bar going up. That's a gains in semiconductors, and a white bar going down. That is declines in software as investors rotate out of software and back into semiconductor stocks. All right, our next guest says that as performance broadens, investors' exposure to the equity market should follow suit. So let's kick things off this hour with Katerina Simonetti. She's executive director at Morgan Stanley Private Wealth Management. Katerina, good to speak with you. I guess we can look at what's been going on in semiconductors as kind of a way into our conversation. After the sell-off in July in that group, the word that keeps coming up in every conversation seems to be rebalancing your portfolio. Does a rotation between software and semiconductors count as effective rebalancing?
Well, Scarlett and Isabella, thank you for having me on. And you are 100% right. As investors are getting so enamored with AI, the possibility that it brings all across the sectors, and of course, various parts of technology, this is where it's very easy to fall into this concentrated positions or being so concentrated in one sector. And while we might be diversified in technology, we're not quite exposed to other sectors. And this is where our view of broadening of the market, takes place when we look at the potential that AI holds across the sectors, in financials, in industrials, in healthcare. It truly is amazing. But we also need to see the dips of the market, just like we saw recently, as buying opportunities, but also understand that volatility is here to stay. And it is something that we are going to be dealing with as tech investors.
So it sounds like rebalancing entails lightening up on technology overall, and that includes semiconductors and software companies, and perhaps adding to other industry groups. What's the single biggest sector that you like right now, your most favored one?
I would say that the sector that in our view is positioned the best is financial sector, because one is we see the AI implementation. And again, when the game right now that is everybody is trying to play is how to monetize this AI investment, and financials, especially the large financials, tend to be positioned best in that space. not only that, there is a possibility of the higher for longer as we see that the geopolitical situation in Strait of Hormuz and, the Iran conflict, is presenting this uncertainty. And most likely we're going to have higher oil prices that are affecting inflation and pushing profitability. This environment is actually a positive environment for financials. So there is a great buying opportunity and the opportunity to receive some dividends as well as the appreciation of these stocks. So that is our favorite sector right now.
So lots to unpack there. If the Fed does stay on hold through the year end, which in your view breaks first? Is it the equity market, the bond market, the dollar?
It's hard to be, in Fed's mind right now, right? Because it is such a tough decision with the uncertainty of the markets. But at the same time, what we just saw is the easing labor market and the cooling inflation. So our position is Fed most likely is going to stay on hold for the remainder of the year. But we still have to be realistic that there is 30% chance that they're going to raise rates. And if that were to happen, there absolutely is going to be weakness in the equity market. And, we have to be ready for it, not to panic. But that's where the rebalancing of the portfolio takes place. On the fixed income side, higher rates always present opportunities. We think that the sweet spot is in the investment grade intermediary space. And of course, it could also present the volatility to the current bond holdings, but this is something that, we encourage investors to see as a passing phase, because inflation, eventually with all the functions and the policy of the Fed is going to come down. And that's where the Fed is going to come back to the lowering of the rates, like in seeing that as a policy. So we would encourage investors to view this as an opportunity to pick up high quality bonds, the higher paying bonds for their portfolios as part of the diversification.
And you also mentioned oil. So how high do oil prices have to go and for how long before you call the Iran shock a genuine inflation problem?
It's a tough question, and here's why it is tough. Because at some point, let's just say with oil prices between 95 and 125, oil is going to put inflationary pressures. This is something that will absolutely affect the economy, affect the earnings. But this is something that Fed will be able to control by rising interest rates and slowing the economy down. We know that this is what's in their toolbox. If price of oil were to go farther, and it's a very unlikely scenario, then we could potentially go into an oil-based recession. And that scenario is currently not in our books. This is not something that we are forecasting, but it's something that has to, of course, be considered as, the one of the worst case scenarios if this conflict were to be prolonged.
Yeah, it can't be dismissed. Katerina, what's the number one conversation that you are having with your clients? What's the question they are asking you?
The question they're asking is, can this market continue? Because when we look back, not at one, not at two, but at the last 5 years and the returns that we're booking for the portfolios, they're historically unprecedented. And what we tell them is that this is the conversation about the fundamentals. This is the conversation about the earnings. This is the time to be very selective and very careful in that portfolio design. That the story of AI and the story of us moving into the next phase of productivity is not just the story of one individual company. This is just a story of our broader global economy. So therefore, we think that the global exposure is important while we're leaning on US and being very much in tune with what is happening in the economy and being on the forefront of these opportunities all across the sectors is something that is going to get us through the noise.
Yeah, it makes sense given that we're on the cusp of a fourth straight year of double-digit gains for the S&P 500. Katerina, thank you so much. Katerina Simonetti is Executive Director at Morgan Stanley Private Wealth Management. Now, coming up on The Close, AI-linked stocks are popping on Anthropic's preliminary revenue figures. We're going to discuss the risks and challenges to large-scale AI adoption with Nora Wittstruck. She is Chief Analytical Officer at S&P Global Ratings.
Plus, from new tech to new voices, our own Romaine Bostic joins us with a timely conversation with former PepsiCo President Derek Lewis.
And critical insights into the state of fintech with a longtime leader in that space, Kahina Van Dyke, operating partner at Advent International, joins us with her perspectives. All that and more coming up. This is The Close on Bloomberg.
AI stocks, including Sandisk, getting a lift after Anthropic reported preliminary second quarter revenue of $11.5 billion. That's at least 14-fold increase year over year. Our next guest says AI spending and adoption won't change credit quality overnight. She does see government recognizing the technology's potential. Joining us live is Nora Wittstruck, Chief Analytical Officer for Governments at S&P Global Ratings. Thank you for joining us on this Monday, Nora. So what will make you change your view and say that, okay, AI is now materially affecting AI credit quality?
So I think it's important to just say, like, AI is a huge umbrella of things, right? It can be technology, it can be a whole bunch of things. It can be data center investment and digital infrastructure. I think for governments, what we're really looking at is how they can leverage the efficiencies or the operational aspects of AI tools, Copilot, things of that nature. And it's probably not going to be sort of an overnight transition to where it affects credit quality. Even our companies, I'm sure Bloomberg, I know S&P Global Ratings, like, we're still trying to figure out how to best utilize it while also protecting intellectual property or confidential information. And I think for governments, that's a key aspect, is ensuring that they don't inadvertently release confidential information.
But how do we know whether governments are actually saving money with AI rather than just adding a very expensive tech layer on top of it?
I think that it will come, but it's not going to come right away. You have to amortize that investment before you can really leverage the outcomes of it. So it's probably going to be maybe in a couple of years or something like that, that maybe the cost savings are really evident. I think it will also happen as a number of people retire from government services, which we're beginning to see. And maybe they're backfilled with, a tool or something that can do that repeatable task, like look at a permit to make sure it's fully complete, or read an HR employment form or something like that.
I'm thinking that some states, some municipalities will inevitably move faster than others in AI investments and adoption. For instance, a very simplistic way of thinking about it might be California, which is home to Silicon Valley, will probably have a comfort level with the technology that perhaps other states don't. How do you think about potential early adopters and the opportunities that creates?
I think there's a lot of opportunities, but what's key is making sure your employees are trained and comfortable with the tools. So, do they know exactly how to make sure that the tool is not hallucinating maybe some outcomes or some information that you're trying to get access to, making sure it's not erroneous. So you want to make sure that there's that human person reviewing the information. I think generally people are getting more and more comfortable with the tools, especially maybe those that are off the shelf, like Copilot or ChatGPT or something. But sometimes I think organizations, governments, not-for-profit enterprises will have to do a bit of customization to make sure that it's unique to their organization and can accommodate certain aspects of their organization that might be a little bit different than just Microsoft Copilot off the shelf.
Do you think, well, there's that idea that personnel is policy. Do you think that elections will lead to different governments that are inconsistent with applying the use of this technology, investing in it and adopting it overall, that will get swings from one extreme to the other depending on who's leading that particular office?
I'm not sure the election outcomes would drive that necessarily at the local level, but I definitely can foresee that some organizations who either have highly complex operations, let's say like a utility or New York City or some other large states that have very complex organizations, they might be a little bit quicker to adopt it because they might see the benefit sooner than maybe some of smaller organizations and governments that we rate.
I know it's hard to generalize, but generalizing, are governments moving fast enough, or do you think bureaucracy and procurement are risking leaving them behind?
I think procurement for governments, as you probably know, there are typically at points at which a governing body has to either okay the procurement or go forward with the procurement based on a certain value of the contract or something of that nature. Obviously, there's infrastructure projects that are bid out, and you sometimes have to take the lowest bidder of that project depending upon how the contract is formulated. So I'm not exactly sure that governments are always necessarily best positioned to be like early adopters, but I definitely see, we observe and we hear from management teams, particularly in places like the healthcare industry and acute care providers, that might be adopting a little more quickly.
So is that the industry that's kind of leading the way out of everything that you're surveying, that you kind of monitor? The healthcare industry is moving the quickest?
I would say I'm not sure they're moving the quickest, but I would say they might be a little further ahead because they're already familiar with a lot of sort of the optimization through electronic healthcare records that were adopted in the 2010s and other things where they can leverage maybe some, if you're watching any medical TV show, they're all doing like, AI assisted notes on files and things like that. Yeah. So, I mean, I think that's not untrue. It is, fictional on TV, but it's actually happening as well. So I think they are a little more motivated just based on some of the things that they've already seen in their industry that are a bit more AI-like, if you will.
We have 20 seconds left, but you made a point of, you saw that in the pit. I was going to ask, what's one function that you see this to be the most actionable in the near future? Maybe the first that the governments will adopt.
Well, I think we're already seeing some of it, which I think is really beneficial in like a 311 system where someone calls in and needs something or maybe report something and it gets sort of like, your voice automation gets you to the right department. I think that is a really helpful thing for governments to be actioning on. And it's kind of, I wouldn't say easy because nothing's easy, but I would say it's probably a little easier than some other things that they might be using AI for.
Right, taking small steps in any case. All right, Nora, thank you so much for joining us
Thanks
today.
for having me.
Good seeing you. Nora Wittstruck is Chief Analytical Officer for Governments at S&P Global Ratings. Coming up on The Close, what's behind the drop in shares of Shopify today? We're going to unpack that move. You can see the stock lower by almost 3% on this Monday afternoon. This is The Close on Bloomberg. It's time now for our top calls, a look at some of the big movers on the back of analyst recommendations. First up is Etsy. Goldman Sachs reinstating coverage of the online retailer with a neutral rating after its sale of Depop. Analyst Eric Sheridan attaching an $89 price target, saying Etsy has intentionally positioned itself to be a share taker and first mover as the world increasingly shifts towards agentic commerce. The stock is down about 1.5% today. Next in line is Apple. Rothschild and Redburn upgrading the iPhone maker to buy from neutral on the back of underappreciated strength in its product roadmap. This, along with its entry into foldable phones. The firm boosting its price target to $400 from $260 as rising costs are squeezing those with lower margins, improving Apple's perceived value proposition. The stock little changed on the day. And finally, Shopify. Phillips Securities cutting the stock to accumulate from buy after a recent upswing. More of a pause than an outright downgrade, with the firm saying Shopify continues to deliver robust growth while remaining well-positioned in agentic commerce. The shares down about 3%. And those are some of our top calls. Now we're going to stay with Shopify. The shares, as you can see, on pace for the worst day since July. Let's bring in Anurag Rana, Senior Technology Analyst at Bloomberg Intelligence, who covers the stock. So Anurag, let's talk a little bit about Shopify here and the positioning it has in agentic commerce. Would you agree with that idea that it remains well positioned and is kind of just seeing some of the recent gains being removed on a day like today?
Yeah, and in our view, Shopify is one of the better positioned software companies to just benefit from AI at all. I mean, these guys have been investing aggressively, taking market share. The growth rate, what they have shown over the last 3 years, has been very impressive. And when it comes to agentic commerce, they're doing a lot more than anybody else has done. Their catalogs, out there for agents to do shopping. They have, you could say a payment system that combines with Google. So, I mean, I think they are at the forefront of everything AI as it relates to digital commerce.
Yeah, you look at some of the revenue numbers, it's seen growing at a low 30s% rate, and that would mark the 6th straight quarter of revenue growth exceeding 30%. It feels like that is the benchmark now, and anything below that would be seen as a disappointment. Are there any competitors in the space that can log similar kinds of growth?
So, when it comes to Shopify, if you go back even a little bit before that, 2 years before that, the growth rate was in the 20s. And one of the things I would say is they have done an exceptional job of gaining market share, at the expense of some of the bigger rivals that they have, the likes of Salesforce, Adobe, Oracle, and, yeah. So what they're doing is they're basically saying we have the most, you could say, well-developed platform out there for you to do all things, whether it is not just digital commerce, but also when it comes to social commerce. And the pace of innovation that they have is far supersedes, everybody else at this point.
What about Workday? How do you read what's happening there? I mean, is enterprise software in general actually monetizing AI yet? Or do you think they're still in the selling phase and the convincing investor phase? Or I guess maybe investors actually don't need convincing when it comes to enterprise software.
Well, the biggest, if you go back last, 12 months or so, the entire software space has been decimated with the fears that, people will wipe code their own software internally and they won't need these packaged software companies, which have been for the longest period of time, one of the crown jewel of any S&P, index you could think of because of high growth and high profile. But what's happening, not just with Workday, but the entire software space right now is people are investing aggressively in their AI infrastructure and even in hardware, and that's taking away share from enterprise software. The other thing that's happening is Fortune 2000 companies are not hiring at that same rate. So when you are a company like Workday that gets priced on per seat basis, if your customers are not hiring much, they are not also buying your software. So their growth rate has gone down from 18% to 15 to 14 and slow. But we think that's not because of AI. That's just they don't have that much funding to buy seats, or the clients don't have that funding. So I think there's a big shift going on for Workday. We don't think they'd get disrupted with AI. I think they're going to benefit in the long run, but the growth rate needs to go up before people get comfortable with that.
When you look at Workday and Shopify in the broader landscape, what is the biggest risk that investors are underestimating? Is it probably the AI disruption, slowing growth, or just the fact that these stocks are so richly valued?
No, I wouldn't call them richly valued. In fact, they have been decimated, frankly, from their historical valuations. I think the biggest concern really is the pricing of these products going forward. Can they keep up with that seat-based model? And if global corporations are not going to add more headcount to their overall portfolio, I think how are they going to show growth? I think that is the biggest question for everybody, especially. And if they transition into an AI-based model, which is more consumption-based, how are they going to price things? I think the pricing part of it, in our view, is a bigger unknown rather than them being disrupted by AI.
All right, good stuff. Anurag, always a pleasure speaking with you. Anurag Rana is our senior technology analyst at Bloomberg Intelligence, joining us from Chicago. Now, coming up on The Close, we're going to head out to Martha's Vineyard for a check-in with The Close host Romain Bossack. He is sitting down with former PepsiCo executive Derek Lewis. That is coming up next. This is The Close on Bloomberg. It's just about 3:30 p.m. in New York. This is the Countdown to the Close. I'm Scarlett Fu.
And I'm Isabel Lee.
Bloomberg's New Voices initiative is holding its latest event out in Martha's Vineyard this week as the next generation of female and minority media professionals converge on the island. So let's go over now to the Close co-host Romain Bossack, who is out on assignment in Martha's Vineyard. Romain's been working all weekend. Tell us what you've been up to, who you've been speaking with.
Yeah, it's been a tough assignment, Scarlett Fu, out here in Martha's Vineyard. But you mentioned the New Voices program. 8 years in running now, where we really kind of try to sort of root out established executives, but maybe not necessarily executives that do a lot of media. We go from city to city, try to find these folks, get them trained up, and bring them to the forefront. And as part of talking to those new voices, and this is the first time that we are here in Martha's Vineyard, we also talk to the established voices. We had a chance earlier today to catch up with the former president of PepsiCo's North American beverage unit, Derek Lewis. We caught up with Kahina Van Dyke. She's an advisor now over at Advent International, but a lot of people might remember her. She was running Facebook's digitization strategy back in the day, basically a payment strategy leading up to that launch of Libra. She was at Standard Chartered for a lot of years. Tomorrow, we're going to catch up with Roz Brewer, the former CEO over at Walgreens, and of course, former COO over at Starbucks. Derek Hall, who runs Rise of the Rest, the Revolution. This is the big venture capital fund created by Steve Case, the founder of AOL, to try to sort of disperse venture capital away from just kind of the big coastal communities and into sort of, I guess, the flyover states, if you will, and some of those more underrepresented groups.
Got it. Sounds like you're busier there in Martha's Vineyard than you are when you're back in New York. We're going to check in, of course, with you later on. But Romain Bossick, the Close co-host, let's get to one of those conversations that Romain was just telling us about. He spoke with Derek Lewis, the former North America president of multicultural business and equity development at PepsiCo Beverages. Take a listen.
Well, I retired at the end of 22. I wanted to shift really from a long, great career at PepsiCo, 35 years, it's 3.5 decades. What a great run, a great company that has a ton of obviously powerful brands, powerful operational capabilities, powerful talent leadership, culture was unbelievable. So, but after 35 years, I wanted to do something a little different. I wanted to pivot away from just being a go-getter. I was a go-getter for really most of my entire career, and I wanted to shift to something more balanced. I wanted to be not only a go-getter, but also a go-giver. And so I want to have a little bit more purpose in my life. And so the things that I've shifted to now are certainly more purposeful for me, and I keep that balance. So I didn't want to shift completely to being just a go-giver, no go-getter. So now I've found that right balance and that right rhythm in my life now. And so I've been enjoying that since I retired, and it's been a really fun ride. The second chapter, or the next act, has been just as fun.
But part of that chapter, though, is, I mean, you've made some investments in the restaurant space, basically as a franchisee. Why restaurants?
You know what? I had this affinity for restaurants growing up, for Philadelphia food, cheesesteaks and pretzels. I grew up on those. I live in D.C. I grew up in D.C., but it was always a treat when I was able to eat a cheesesteak, eat a pretzel. I moved around the country a lot, and I craved those foods. I always craved the Philly cheesesteak when I was living out west. I lived in Phoenix. I lived in Portland. I lived in Denver. And I could never really find a great cheesesteak. A really great soft pretzel, right? So I've always found myself craving those foods. And when I came back in my general management roles at Pepsi, and essentially also the multicultural role, I ended up working with a lot of entrepreneurs, particularly one, the brand I own now, Big Dave's Cheesesteaks. And so I supported that brand, in terms of my work. I also found, got to love the business itself, love the owner, love the business itself. So when I retired, we talked, and here I am now in the business, a couple of units open in Orlando, also have a Philadelphia pretzel factory. I just opened. So being a multi-brand franchisee is a fun thing to do. I'm creating jobs, I'm adding economic impact. I've got great relationships within the Orlando community, particularly within the sports realm as well. So these collaborations are really, really powerful to get the brands off the ground and fulfill engagement.
With regards to expanding the business, I mean, do you try to just do that organically, meaning just reinvesting back in the business? Do you look for outside capital? I mean, how does that work?
I think it's all the above. I think you want to, first and foremost, want to get off to a good start and prove the brand can drive the value in the marketplace, right? Then that opens up a lot of opportunities. There's certainly been a lot of inquiries around expansion, and I'm certainly looking forward to expansion in the future. We've hit, obviously, this economic cycle has been a challenge with the businesses, but they're stable, they're doing well. I've had virtually no turnover, so I've got a great team, a great staff. We're building great equity amongst the community, and so I look forward to building upon that as we go forward in the future here.
But given your time at PepsiCo, I mean, you know economic cycles, and you know how consumers shift their spending when times get tough. Just give me a sense kind of where you think we stand right now, because depending on who you ask, some will say the economy is doing great, others will say the economy is not doing great. I guess it depends on your income level, maybe.
Right, I think it's mixed. I think, for all, I think consumers are being very intentional right now. First of all, they have more choices, they have a lot more information, and they have higher expectations, right? And so while value is still at the center of their decisions mainly, not just from a pricing standpoint, but also from an experience standpoint, personalization matters, convenience matters, speed matters. All these things go into called the value equation for consumers. So they're being a lot more selective. I did hear a stat the other day that 10% of America's consumers are driving 60% of the economy. And so it really tells you that there is certainly a lot, that the top end is certainly generating the most of what's going on out there. And that's sort of that, other 90% are being very, very selective. Some cases pulling back. But also, I think it's more occasion-based. I think in some cases you see consumers lean into premium when it really, really matters them personally. In other cases, they lean into value because they're trying to create that balancing act. So I think at the end of the day, being selective, I think earning a consumer's trust and loyalty is so important. That's what I'm trying to do. I want to earn it because I know it's hard to earn, but easy to lose.
I do have to ask you about your last role at PepsiCo as head of that multicultural investment business. Obviously, that was kind of born in the aftermath of the George Floyd murders and the intentional move by a lot of companies to find ways to sort of embrace and if not invest directly in the black community and other underserved communities. Was your departure in any way a reflection on maybe that commitment waning?
No, not at all. I think the company, has a long legacy and history of investing in those spaces. If you think about the demographic shifts that are occurring, you want to capture that. Brands want to capture that. From a talent pool standpoint, you want to capture that. So there's no reason to turn away from that at all. Certainly resources get deployed a little bit differently in intention. I was asked to stand that up because, quite frankly, the work that I was doing as an operator when I was in the South and when I was actually ahead of the North America footprint, the best practices that we were putting in place to invest in those communities, to invest in those consumer groups, to really keep the holistic greater good at front and center was the reason why our business results were really, really strong. So the company said, hey, look, can you take these best practices that you're doing on a geographic level and scale these across the enterprise? We want to make sure everybody is participating in the ability to reach all the consumer groups that are out there to grow our business. Because this is always about the business case. If you're not growing revenue and profit, there's no need to talk about investing in these other activities. But I was able to demonstrate you can do both. You can actually do well from a performance perspective. You also can do good from a purpose perspective, and both can coexist and drive the greatest results possible. And that's exactly what I did. And that's the intention of setting up that business unit, was to do that across scale, across the entire organization.
It makes a lot of sense, and it certainly made a lot of sense in 2020, 2021,
Absolutely.
2022, and 2026. Can an executive walk into the CEO's office and make that same pitch given the political climate?
I think you're going to have to do it differently. I think you're going to have to position it certainly a lot differently. You still have to obviously keep the greater good in mind, but being surgical in places that are going to absolutely drive incremental lifts in your business and not erode your core, because quite frankly, a lot of the demographic changes in the company are a big part of the growth that the company is a lot of companies are realizing. So you're not going to want to disrupt that. So staying true to growing the business there, but also investing in their communities in the same manner, or certainly in a manner that's consistent with what those consumers believe to be a company they want to stay loyal in. You have to be very mindful of that, because you have to be careful about that. But I think you have to sort of reimagine how you do it. You have to rebrand it. You can't live off of legacy programs anymore. I think the ones that are most creative and the most collaborative and thinking about the collective, I think are going to be the ones that win ultimately. And I don't know why CEOs would not get behind that. It would totally make sense to support those individual leaders that can still convey that message, but do it in a broad-based sense that nobody's left behind.
And that was the Close co-host Romain Bostic speaking with Derek Lewis, formerly of PepsiCo. We do have some breaking news, but before we get there, don't forget that we're going to have another great conversation with Inkwell owner and Advent International operating partner Kahina Van Dyke. Romain speaking with her at the Martha's Vineyard event as well. All right, let's get to the breaking news now. Anthropic's revenue run rate has surpassed $65 billion ahead of its IPO. It's on track to generate annualized revenue of more than $65 billion based on its current performance. This is according to people familiar with the matter. Just for context, that is up more than sevenfold from its pace at the end of last year. And these are numbers that, of course, make a huge difference, Isabel, to investors who are anticipating the IPO of Anthropic as well as its rival OpenAI.
And it's interesting because Anthropic was once the underdog, and we have a reporting from Bloomberg also that shows that OpenAI's revenue run rate recently exceeded $40 billion. So, of course, those two may not be measured apples to apples. Maybe they're more apples to oranges, but it's still really spectacular numbers coming from these big two companies.
And of course, these are much anticipated IPOs at some point this year or next year. We'll have more. This is The Close on Bloomberg.
Our stock of the hour is JetBlue. Shares under pressure after Seaport analyst Daniel McKenzie, the last remaining JetBlue bull on Wall Street, downgraded the stock on fuel volatility concerns. So joining us live is Bloomberg TV Markets correspondent Nora Melinda. So Nora, why all this negativity around JetBlue, and what could we do or what should we see for it to improve?
Yeah, I mean, so JetBlue is not unlike any other airline right now. They're all exposed to the idea of the higher fuel prices that we're seeing really being sparked by the ongoing conflict in the Middle East. But what's different about JetBlue than its competitors is its debt load. And that's the concern. So if prices continue to go up and we're still seeing this elevated price for fuel, what does that mean? Does that mean that they have to take on more debt if they don't really have any cash to work with? What could that mean in the long term? So that's why you're seeing Seaport coming in here, downgrading the stock to neutral from buy, which they had actually just previously upgraded to buy just back in April. They were saying that they would essentially be able to benefit from Spirit Airlines, and they thought that the war wouldn't persist as long as it has. But here we are sitting in August, and it's still ongoing. And so they're now saying, hey, maybe we should cut it back to neutral and see what happens next.
Yeah, an acknowledgement that really no one knows what's going to happen with oil prices. And now we have 10 holds and 7 sells, which is kind of remarkable to see that many sells. You notice within the note, though, there are some kind of extremes that they're cautioning about. What are some of those extremes?
So essentially their base case scenario is that the company's going to have to, going to be struggling a bit, but they also talk about the downside scenario, which could potentially be the company becoming worthless. And so essentially that is coming off of the idea that if the company continues to spend more money and more money and more money, coming off of the fact that prices are so high just to operate some of these planes, what could that mean in terms of whether or not they're actually going to have the capital, have the money, the cash on hand to actually be able to absorb some of these financial concerns? And that essentially would leave investors with not much to work with, essentially, is what Seaport's saying.
Really? I mean, you said you take JetBlue. Maybe I should take JetBlue.
I do take JetBlue a lot because I fly to California, so it's really convenient for that, and it's a New York-based airline.
Fair.
But these are things definitely that make you question some of your decisions sometimes.
Sure.
All right. Nora, thank you so much. Nora Melinda with our stock of the hour, which is JetBlue. The shares are lower in trading today on this Monday. We've got a lot coming up, including the countdown to the close. Keep it here. We're just about 10 minutes away from the closing bells. I'm Scarlett Fu.
And I'm Isabel Lee. So, Scarlett, on this Monday, I think stocks are quiet, but we have some big news in tech world, at the very least, with Anthropic announcing again a $65 billion revenue run rate, which is an eye-popping number again.
It is an eye-popping number, and of course, it gets everyone excited about when this IPO is going to happen.
Yes.
Will it be this year? Will it be 2027? And then will it be followed by OpenAI? These are all questions that are unanswerable at the moment. What we can tell you is that we're looking at a second day of declines in the S&P 500, although you do have the chip makers bucking the trend. They're up about 2%. I think it's the fourth gain in 5 days. So chip makers have continued to see this inflow of interest. What's interesting, of course, is that overall stocks are down, bonds are down, oil is higher. So the macro concerns are really, really playing a prominent role today.
I mean, it's hard because we have a headline risk day after day. I mean, someone told me, I don't want to steal this term, but like it's headline ping pong. And I mean, again, today you have news again that, I mean, a deal to almost end the 6-month war in the Middle East, like that is kind of fading. That's why you see oil prices moving the way they are, but remains to be seen where we stand.
All right, so let's get deeper into all of this and bring in Greg Boutle. He is U.S. Head of Equity and Derivative Strategy at BNP Paribas. And Greg, as we talked about stocks falling, bonds falling, we're seeing the 30-year yield move up, right? It's now at the highest since 2007, since before the great financial crisis. What kind of knock-on effect does that have on equities beyond sentiment?
Well, it's interesting. It really brings attention into the market. And part of the question we have to ask is, why are rates higher? You could look at the correlation of the different equity indices to rates, for example, and you could see that the most negatively correlated to rates is the Russell, the small and mid caps, which intuitively makes sense, a part of the market that suffers more when rates are higher. Yeah, that is one of the best performing parts of the market this year. So perhaps that's more to do with good data than it is the direction of rates.
So when we look at what the next couple of catalysts are going to be, retailers will be reporting earnings. We've got a big earnings report from NVIDIA next week, Jackson Hole. What kind of positioning do you see overall ahead of these big events?
So positioning, we think, is relatively clean. So going into the back end of July, we saw what we think was a bit of capitulation in retail flows. We saw some retail selling right into the back of July. When we look at institutional positioning, it looks somewhere in the middle of the range. And we think in an environment where the market starts to grind higher, that's going to force people to put money to work. So we think certainly ahead of those catalysts, NVIDIA, the key micro one, and then a series of macro catalysts, we think those are going to be the focal points. And we think positioning is such that money can be put to work ahead of those.
But you're seeing another $15 billion from systematic buying in the next days. What's there left to actually sell, though?
Yeah, I think like when we think about the systematic flows, they can be quite predictable for a given scenario. So we know that systematic flows are driven a lot by volatility. As volatility comes down, we see more and more money put to work, and that can be self-reinforcing. And certainly what we've seen over the last couple of weeks is that volatility in the US equity market has come in very rapidly.
And positioning remains only slightly above neutral. What would make you turn outright bullish? I mean, we have all these positive news, I would say, when it comes to at least the tech world, but seems like you're not there yet.
No, we're bullish in terms of our delta view, but I think that one of the things you struck on at the start of this segment was the dispersion that we see in terms of the market. So it's not just a market view. There's different subparts of the market. So you pointed out that semis are on another run today, and that is a part of the market that we are quite bullish on, both because we think positioning there had been cleaned out by retail at the end of July, and also we mentioned that NVIDIA catalyst. NVIDIA is obviously the biggest, most important name for the semiconductor space. The interesting thing about that is when you look at the history of the last couple of earnings, it's not really been earnings that have been a catalyst for outperformance. The stocks have run into earnings. So that's where we are now.
Interesting. Broadening out, rebalancing, these are terms I keep hearing coming up over and over these last couple of weeks after that big reset in July. How is this showing up in what you monitor daily, this idea of rebalancing?
Yeah, so I think what we've seen this year is just these like series of different leadership in the market that you've actually had over the course of the market. Many different parts of equities rally. So semis have done well, S&P, the broad index, has done well, equal weight S&P, Russell, small and mid caps, they've all done well. But it's been different series of leadership. And at the moment, we think we're in this environment where the semis can have a catch-up trade. They're still a long way off their highs, whereas Russell, equal weight S&P all made new highs next week. So we think things like the broadening out trade is an interesting one, but we think you have to be very careful about how you trade it tactically. So right now, I think something like semis or small and mid caps could be a better place to put money to work.
We're definitely in the dog days of August right now. It's middle of August. Labor Day is going to be really late this year. I look at trading volume, and what's interesting is that some of the heaviest trading days this year took place in June. Does the market actually adhere to seasonal patterns the way that it used to, given the increased participation of retail investors?
Maybe and maybe not. There are things in seasonality that work, and there are things that don't work. We certainly saw a week or so ago an absolute explosion in call option activity. So we had one of the busiest days ever in call options in what should be one of the quieter periods of the market. So when we observe seasonality, we definitely do see seasonality in terms of volumes. We see seasonality in terms of dispersion around things like earnings. And we do see some patterns of seasonality around returns. So August tends to be a better period of returns for the S&P than September or October. But I think you have to be very careful with that, because some of that kind of persistence can be quite weak.
Give us a contrarian trade. What is maybe one part of the market that investors are getting wrong?
I think as a contrarian trade at the moment, I think small and mid caps, even though it's performed very well this year, is something that has been going under the radar a little bit in the last couple of months. People have been worried about the backdrop of rising rates. And as I said earlier, it's interesting because the Russell is very negatively correlated to higher rates. So on the face of it, higher rates should be bad for Russell. But I think the idea that higher rates are being driven by a strong economy, that's something that can leave a fatter right tail for Russell than many are anticipating.
Yeah, it's a reason why rates are rising that matters here. I look at the VIX, it's just about 15, above 15, half of where it was in late March. Also a decline from the 20 recorded at the end of July. What does a broad measure like the VIX fail to show us? What does it mask, for instance?
So I think it's interesting because if you look at the VIX, it kind of showed you roughly what has happened, that volatility has compressed a lot and we're at low levels of volatility. What it masks is quite how fierce that volatility compression has been under the surface. What we saw going into summer was there was this massive spread between single name options. So options on single name corporates were extremely elevated relative to the indices, S&P and VIX. Now, directionally, what's happened is volatility has come down over the last month, but the order of magnitude for single names, and indeed for things like semis, has been absolutely massive versus what's a more normal, healthy correction in the VIX.
All right. Thank you so much for joining us today. Really appreciate it. And thank you for coming in. Greg Boutle is U.S. Head of Equity and Derivative Strategy at BNP Paribas. So we've got a couple of big events coming up.
We do.
NVIDIA earnings obviously going to be front and center. I remember when people used to hold watch parties because of these earnings reports.
Even here, like I wouldn't go home and I'd wait for the NVIDIA earnings. But it's interesting because we have JPMorgan saying markets continue to climb the wall of worry. And to your point, there's NVIDIA. We get a slew of retailers this week. There's Fed minutes on Wednesday. I mean, that's kind of backward looking. But then I feel like any chance that investors can get to parse through Kevin Warsh's view, they will take.
And of course, Kevin Warsh and others will be speaking at Jackson Hole the following Thursday as well after NVIDIA results. So we'll be all over that. Let's count you down to the closing bell. Full market coverage coming up right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We're about about 2 minutes away from the end of the trading day on this Monday. Scarlett Fu and Isabel Lee here with you, and here to help us take you through the closing bell is a global simulcast. We're joined now by Carol Massar and Joe Doe, bringing together the best of our Bloomberg television, radio, and YouTube audiences worldwide to parse through the most crucial moments of the trading day. And it feels a little bit like a quiet summer day, Carol, as we await some kind of catalyst. Maybe it'll be retailer earnings. Maybe it won't be until NVIDIA's results next week.
Or FOMC minutes on Wednesday. Having said that, not so boring when you look at the Treasury trade. We've definitely seen U.S. yields ticking higher. We've got maybe the concerns again about the U.S. war in Iran. This as it's pushed. Once again, WTI and Brent higher. We've got WTI crude right now up, Joe, about 2.3%. So that again speaks to some concerns inflationary-wise.
Yeah, it's just another day in these markets with some unpredictable tweets from the president over the weekend that keep us on our toes.
You guys are always talking about that, aren't you? We all
always,
are.
Always.
I mean, we're seeing earnings, we're wrapping up earnings, and it's been really relatively strong. We have Goldman saying that EPS growth is tracking at 31% year over year, but the impact of AI adoption on corporate earnings remains relatively narrow. So again, the winners are still relatively, I would say a small group, but then it's interesting to see the outsized impact that it has.
Yeah, it continues to have an outsized impact, and you reminded us as well, Isabel, of the headline that we got on Anthropic and the 60 billion plus run rate that it's now hitting, annual run rate, and the anticipation ahead of that eventual IPO. All right, we're getting closer to the closing bells, and right now we are looking at declines for a second day for the S&P 500, down 0.5% right now as we hear the closing bells ringing. The Dow Industrials also down about 0.5%. The Nasdaq, the better performer among the three major indexes, down about 1/3%, and the Russell 2000 of small cap stocks, which had been holding it better than some of the big cap names in the month of July, down about 1/3% as well, Carol.
All right, just going back to the big caps, the S&P 500, definitely more of a risk-off trade, no doubt about it, Scarlett. 367 names, Isabel, to the downside as I look at the index, 134 to the upside, 2 unchanged.
And taking a look at the IMAP, you're seeing kind of a mixed picture there. Actually, oh no, mine was taking a while to load. It's mostly red. You're seeing just one bright spot there, and that is energy, which is trading higher. The rest, Carol and Joe, are trading lower.
All right, guys, let's go to some of the individual gainers, if I may. I've got the gainers. Joe has the decliner. So I start with Sandisk. This is your #1 gainer in both the S&P 500 and the NASDAQ 100. Really what we saw, you guys mentioned, Isabel and Scarlett, the Anthropic investment. We continue, or the Anthropic information in terms of its financials and just getting an idea of how big a business it's got and how much growth we are seeing. So AI-linked stocks rising after Anthropic told prospective investors that its preliminary second quarter revenue was $11.5 billion. I know we got another number on them. So Sandisk, that stock was up almost 9% in today's session. Pick your name, though. Marvell was also a high flyer, up about 5.5%. You had Western Digital. That was good for a gain of about 5.3%. And then Coherent was up almost 7.8%. So again, keep in mind, yes, it's the Anthropic name, but once again, investors, just pushing what has been a common narrative, this broader rally when it comes to memory and storage stocks after Sandisk outlined an upbeat multi-year financial outlook. We got that last week. Sandisk continuing to be really a high flyer this year. It is a top performing name by a wide margin in the S&P 500. So there's that group. And then I just got to mention SpaceX, because we've seen this name top in the NASDAQ 100 today, up about 4.5% at the close. Investment firms for ultra-wealthy individuals have built up billions of dollars of exposure to SpaceX. So more than a dozen family offices holding a total of at least $3.8 billion in SpaceX through the first half of 2026. This is according to those U.S. filings, 13F filings. Harvard, too, has a big stake, some 2.2 billion or nearly 13 million shares. So, even though SpaceX has struggled a bit in terms of the trade coming off of the IPO, ultra-wealthy, Harvard, and some others, they definitely want to have a piece of SpaceX, Joe, no doubt about it. It's
interesting to see who's holding the stock now versus when it first went public.
It's a really good point, right? It has certainly moved along a little bit. All right, you've got the decliners.
I've got the decliners. I've got a bit of a mixed bag. Mine doesn't have a theme to it, but we're looking at EyePoint shares. They had a record drop today. The drug developer said its experimental treatment for an eye disease failed to meet a primary goal in its late-stage trial. This is called wet age-related macular degeneration. The main thing here was Cantor cut their rating on the company to neutral from overweight, saying that the trial miss was, quote, a scenario so unlikely in our view that we hadn't even contemplated it in our bull-bear base case scenario analysis in our recent initiation. So that was interesting. They have another trial coming up that doesn't necessarily mean this is the end, so that's one thing to keep an eye on. The next is Bally's, of course, the casino entertainment company. Their shares tumbled the most intraday since February of last year after the company warned investors of, quote, substantial doubt that will be able to continue as a going concern. Listen, the company reported financial results in the second quarter late Friday. Citizens analyst Jordan Bender noted that the situation doesn't appear dire, but we do not believe the company has the ability to finish all of its projects without selling or bringing in a development partner at its current leverage levels. So leverage is a massive thing there. Listen, Bender also noted that they just closed a purchase of Samstown for an estimated $30 million. They have a $4 billion downstate New York casino project in progress, which some folks around here might know about. And of course, it has a Las Vegas development. And finally, I'm looking at JetBlue Airways. The shares dropped as much as 6.7% after Seaport Global Securities cut the recommendation on the airline to neutral from buy. As you know, Carol, I've been talking a lot about Hormuz and Iran today. Yeah. Analyst Daniel McKenzie says the balance sheet risk moves to the front burner without the Strait of Hormuz open, which is a critical assumption around their upgrade back in April. They note, to be sure, jet fuel volatility is a challenge for all, but it's a disproportionate risk to JBLU given the elevated debt levels. So that's just one more thing to look at.
No buy ratings, guys.
No buy ratings. 10 holds, 7 sells. Speaking of debt levels, let's talk about the bond market here. You can see a lot of red on the screen. A sell-off in treasuries, particularly at the long end of the yield curve, goes straight to the bottom there for the 30-year yield. Now at the highest since 2007, June of 2007. That is before the financial crisis. The 10-year yield also elevated insofar as it's at the highest level so far this month. It has not retraced to the highest level that we've seen in July, but still, that's quite some move. And of course, the balance of risk seems increasingly tilted towards inflation, persistent inflation.
All right, guys, we've got a great story that's on our radar, and it's about thieves stealing from trains. You think of like Westerns, old-time Westerns. You think of Jesse James or Butch Cassidy and all that good stuff. Turns out, guys, criminals nabbing more than $200 million of goods from 75,000 thefts on U.S. freight rail networks in 2025, according to an industry group that represents some of the big train names, including CSX. I mean, they're stealing things, Joe, like Nikes and other stuff.
Class 1 railroads back in the news, maybe not for what they want to be known for, but having spent a lifetime covering commodities, the number of heists you hear that are similar to this, people putting copper on flatbed trucks and getting out in the middle of the night, this is a good one that I think anybody would love to read.
I mean, there's some incredible detail in that story where they were also trying to steal cars, but it was kind of difficult to actually move a car somewhere else and sell it on the black market. So they've kind of resorted to things like computer parts or things that are easier to sell on the gray market.
And I think to stave off all of these selling, they're going to try to incorporate, or what is the word I'm thinking of? They're going to put high tech.
Yes, they're going to integrate more high tech.
More. Thank you, Scarlett, for the GRE lesson. But they're going to integrate more high tech, I guess, to really maybe catch the thieves.
They have cameras everywhere, and they've got these massive fences and everything to prevent people from stealing it. But there's a lot of cartels and gangs involved in all this.
You know what? They might try to steal beef.
Yes. Oh my gosh. So that's another story. Because thank you, Carol. Beef is finally becoming a little too expensive for American households. We know beef prices have been going up, and the Trump administration has been doing a lot of work in trying to bring that down, perhaps like opening the door to more imports from Argentina. But it's now come to the point where the growth in beef has started to fall off a little bit, started to turn over. I mean, we're still eating a lot of beef, but maybe not growing at the same pace as we were before.
It's really become a treat. I mean, it's pretty shocking sometimes. You look at some of the prices and you're just like, my husband does a lot of the shopping, and I think at some point I'm like, wait, how much is that steak? And I'm like, oh my God, you could buy, I don't know, not quite a house, but it feels
almost
like
a part of it. That's why they're eating chicken now. I mean, I don't know, I guess it depends on who you ask, but some people say chicken is healthier anyway. I mean, without all the GMO.
Sometimes you need a good steak.
I don't know. I saw people at Costco who were, holding up some short ribs and saying, this one's for the dog.
Wow,
fancy dogs.
Those are the people who are giving their dogs peptides and light treatments, and come on.
Yeah,
the humanization of pets. That line I stole from this story. I thought it was really good.
My dogs are getting dry kibble. What about you, Joe?
I currently just have a toddler to take care of.
Okay. also expensive. Also expensive. All right, guys, that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We do call it the closing bell. Scarlett and Isabel back there on the close on Bloomberg Television. Joe and I back here on Bloomberg Business Week Daily. Folks, we will see you again, same time, same place tomorrow.
Coming up on the close, we've got an assessment of the opportunities across alternatives with Aaron Mulvihill. He is Global Alternative Strategist at JPMorgan Asset Management. That is coming up next in the second hour of the close, right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
Welcome back to the close. I'm Scarlett Fu.
And I'm Isabel Lee.
All right, we took a look at where markets closed on the day. It is another down day for U.S. equities. The S&P 500 last week closed at a record high. Today, lower by 0.5%. But chip makers did not participate in the sell-off. They were higher for a fourth day in 5, a 1.6% advance for the Philadelphia Semiconductor Index. Oil prices are higher and bond yields are higher as well. The 30-year yield, Isabel, now at the highest since 2007, before the financial crisis.
That was really the big headline grabber last week. I feel like everyone was just talking about that because it just really raises questions on what it will mean for the fiscal deficit of the nation. And obviously, it will be a headache for those in Washington.
Absolutely. You've got some movers, individual movers that you're watching?
I do have individual movers. Thank you for reminding me. So Centene, this is a health insurer. Shares are down after the company reported its CFO plans to retire at the end of 2027. You see the stock there down by 4.5%. JetBlue Airways, we talked about Scarlett always taking this when she goes to the West Coast. Shares are also down. It actually closed even lower by 7.5%. That's after Seaport Global Securities cut its recommendation on the airline to neutral. The analyst over there, Daniel McKenzie, says the balance sheet risk moves to the front burner without the Strait of Hormuz opening. And finally, Shopify, another red. I basically choose all the red losers. Shares are down by 3.5%. That's after Phillips Securities downgraded the e-commerce platform to accumulate from buy. So price target is now $170 from $160, Scarlett.
All right. Let's also remind everyone that big headline that we got in the last hour, which is from Anthropic, on track to generate annualized revenue of more than $65 billion based on its current performance, according to people familiar with the matter. AI certainly remains a central market story with those impressive figures and it helping to lift stocks tied to the AI build out. Our next guest says that the massive funding flowing through that space is transforming public and private markets. Joining us live is Aaron Mulvihill. He is Global Alternative Strategist at JPMorgan Asset Management. And Aaron, it goes to the point of all these hyperscalers and hyperscaler adjacent companies have a lot of things that they're spending on, and they need to find money to borrow from wherever they can get it, whether it's the public markets or the private markets. And the problem that creates is for investors, they need to work really hard to make sure they're not overly concentrated in tech, whether it's in equities, in public credit, or in private credit.
They do, Scarlett. It's increasingly a challenge for any kind of investor. If you're investing across the public markets, the private markets, one of the charts in our new guide to alternatives is looking across all asset classes and seeing where technology is making up a greater share. And today you look at the public markets, and we're well aware of the S&P 500, 40-something percent, 47% in our latest analysis is tech. If anything, that's an understatement because it doesn't include some companies that we classify as consumer goods companies but are buying a lot of AI chips. And then in the private markets, we have a lot of announcements the last couple of weeks of asset managers, private equity, private credit, again, contributing massive amounts of commitments to build out AI data centers. So that's something that technology, not just technology investors, but all investors need to be aware of, the technology concentration in markets today.
Absolutely. And we've already seen some of the damage to private credit funds with a lot of investors trying to redeem their stakes in those companies and trying to exit some of that position as much as they can, although they're often stopped by the mandates. For those who are able to get some of their money back, how are they redeploying it? Where are they moving it to when it comes out of private credit?
So the first quarter, and actually it's flowing into the first half of this year, has been interesting in private credit. We saw a bit of a pullback from retail investors, private wealth investors, institutional investors, not so much, and they make up 90% of the private credit market. And we're seeing that redeployed into, again, private market assets. But into areas like venture capital. Certainly has attracted a lot of fundraising in the last year or so because investors want to get some shares of these pre-IPO companies. Other areas, real estate is seeing a bit of a turnaround. It's been priced below where it was even pre-COVID. So the real estate fund we track is about 24% below pre-COVID levels still. So a lot of bargains there, and it's hard to find bargains anywhere in the market today. And then infrastructure is the other area where we see more assets being redeployed. That's investing in the power layer of AI. So it's sort of AI adjacent, but it doesn't necessarily come with the volatility that a lot of the AI infrastructure or the AI play comes with.
So you mentioned infrastructure. Is the AI trade becoming an infrastructure bubble? And where do you see that investors will be most at risk when it comes to that?
So there's a lot of ways to play it, and increasingly in conversations with our clients, the bubble question is coming up a lot. And it really comes down to where do you invest across the value chain? Because it's very challenging to know who will be the beneficiaries. Will it be the data center companies? Will it be the model builders? Will it be the companies that are using the models? And so it's important to invest across that chain, not have too many eggs in one particular basket. Certainly the data center play, direct data center investment comes with some risks. We are concerned about the risk of overbuilding of data centers. There's the risk of obsolescence. And so we like the power layer more as a lower volatility play because AI is not the only thing driving electricity prices and electricity demand. You've also got EVs and other parts of the economy.
Which is the bigger risk, the obsolescence or the overbuilding? And when do we know? I mean, the balance of the two must be hard. Now it seems like, judging by the headlines, it would be the risk of overbuilding so far.
Both of them are concerning investors right now. It's very difficult to tease apart. And I think one of the big challenges right now, whether you look across the public space or the private space, is the increased complexity of some of these deals. So you look at the amount of off-balance sheet financing that's happening. That's been a big story over the last couple of days. And so it takes increasingly large teams of very sophisticated researchers to understand bond issuances, to understand private credit deals, private market deals. And for passive investors, that's a real challenge. You're just bought into an index and you're along for the ride. So we think it certainly bolsters the case to be an active investor, to work with asset managers that can work across public as well as private assets.
So if you're actively trying to reduce some of your exposure to the AI trade overall and the AI adjacent trade, you want to still get double-digit returns, but you don't want that much AI exposure because you've got plenty of it already. And you also don't want that volatility. Where can you go? What's left to look attractive at this point?
That's probably the biggest question that we're getting from clients right now, because nobody wants that sort of eat your broccoli diversification of take lower returns. Real estate is an interesting area for us. Commercial real estate, I would say cautious about the data center and digital part of real estate, but the traditional commercial real estate market we see is attractive right now. And other areas would be small to mid-cap private equity. So investing in the consumer goods, organic growth stories within private equity. These companies used to be in the small cap market in public markets. They're no longer listing because now we're seeing larger and larger listings. It's hard to really justify doing an IPO if you have a company that's less than $3 or $4 billion in revenue. So they're staying in private equity, but a lot of high growth stories today in private equity.
I want to go back briefly to private credit, which Scarlett asked earlier. You said the trouble spot there is software. How bad could that get if it does blow up, or maybe blow up is kind of an extreme word that will anger some investors, and who is most at risk?
Yeah, that's the billion-dollar question, Isabel, and that's, we think, what's been driving some of the pullback from retail investors is it's not that software has underperformed. It's not that we're seeing defaults in this space. We're not. I would stress that. The performance has been acceptable, but there is a concern that AI could be disruptive to software. Now, that might be an overblown concern. If we look at the equity markets, software sold off in earlier this year, and a lot of software names have come back very strongly. It's been one of actually the best performing sectors in the last couple of months in the equity markets. And we may see the same thing play out in the private credit markets, but it comes down to research and really understanding the companies underlying that are issuing this debt, and then coming to determination, are these the companies that are likely to be winners or losers in the AI trade going forward.
understanding the companies and researching and maybe just not follow the hype. Thank you so much for joining us, Aaron Mulvihill. He is Global Alternative Strategist at JPMorgan Asset Management. Always a delight to have you. Still ahead, we'll set you up for the big box retail earnings due next week, or rather this week. We're already on Monday. Plus a look at the restaurant stocks as Cyclospora concerns continue to swirl. All that and more coming up. This is The Close on Bloomberg.
Concerns around foodborne illnesses putting pressure on restaurant stocks in recent weeks. Corporate executives and health officials closely tracking the cases cropping up across the country. The Close caught up with many of the key stakeholders in recent days. Take a listen.
A double whammy of foodborne illness is putting consumer trust to the test. An outbreak of the parasitic pathogen Cyclospora tied to raw lettuce, plus a salmonella flare-up tied to jalapenos. It's putting restaurants and food brands under pressure.
Cyclospora has had an impact on our business as it has had an impact on really anyone selling fresh produce.
We wanted to be prudent with our guidance and take into account what we noted to be the impact of some of the broader concerns around food safety issues.
People are eating a little bit less screens as they sort of process the information that's been happening.
But it wasn't too long ago that some CEOs didn't sound so concerned.
We're not affected at all. And I think customers understand that the supply chain moves very quickly. The product's probably out of the supply chain and everything's fine.
We have gone through our supply chain ingredients with our partners to understand if any of our ingredients have been indicated in the Cyclospora outbreak, and they haven't to date. We don't expect that they will.
But now, food safety concerns, they're just too big to ignore. Placer.ai, a foot traffic analytics firm, says visits are down at some major fast food chains, including Taco Bell, where the CDC traced part of the Cyclospora outbreak.
It's all about communication. When consumers don't have confidence in, what happened to cause the outbreak, what solutions were put in place to make it happen, that makes it very difficult.
And it's that communication that could be the difference between a short-lived hit to traffic and a long-lasting blow. Think about what happened to Chipotle nearly a decade ago. A string of outbreaks leading to a sales plunge and the departure of the company's then CEO, Steve Ells. But those missteps may have prepared the chain for the latest scare, with the company identifying and replacing tainted jalapenos days before public health authorities issued that official recall.
Sometimes you can think of these investigations as being like a jigsaw puzzle. There can be a lot of different pieces of that jigsaw puzzle, and trying to figure out exactly how they all fit together. Sometimes piecing that all together takes some time.
I would also say 25 to 30% of the overall CDC workforce is gone. And so you've got less boots on the ground being able to do these inspections and investigations.
And while officials work to connect the dots, restaurants are left scrambling to ease customer concerns and rebuild trust in the food they serve. I'm Romain Bostic. This is Bloomberg.
Our thanks to all those health experts and restaurant executives who did speak with us. But Isabel, if you look at the shares of restaurant companies, they've certainly been hit by the Cyclospora news that has been swirling around. And you could see that it's not been a complete recovery.
It's not been a complete recovery. If you look at the 1 month, Sweet Green has fallen 16%. We have Chipotle down by 2%. But Kava is a bright spot. So it's also interesting how they reacted differently. I mean, they all have greens. We were talking about it. You were asking, does Kava have greens? And I'm like, yes, Scarlett, you can choose rice or greens. But even then, I mean, Chipotle, there's a Bloomberg intelligence note, and they were saying that it's the jalapeno peppers that spooked some people. And I feel like for me, I just think of the greens, but there are other kinds of vegetables.
It goes beyond just the lettuce. There is a related story, I suppose, if you think about how Chipotle is trying to change the conversation. It's giving away more than $1 million in free food starting tomorrow by bringing back this Chipotle IQ game. Again, changing the conversation, making sure that people, remember that they have other things beyond greens.
We should line up. Should we? And we stream
the IQ test over at Chipotle. We'll make it a closed event. How about that?
But you're right, because Chipotle, I mean, more than any other compared to others, they have a lot of dishes that is more protein heavy compared to just greens. Maybe. We should definitely go.
Okay, we're going to work on that one. Coming up, we're going to head back out to Martha's Vineyard for a look at Romain's conversation with Advent's Kahina Van Dyke. That's coming up. This is The Close on Bloomberg. We are back with more from Bloomberg's New Voices event in Martha's Vineyard. Romaine Bostick sat down with Kahina Van Dyke, the operating partner at Advent International, in a wide-ranging conversation on everything from stablecoins, fintech consolidation, as well as the rise of AI. Take a listen.
When I joined the Citibank Internet team, I was the 7th employee. There was no fintech name, but we did believe that the internet was coming and that was going to have an impact on the digital world of money. It was an unproven theory, but you put a bunch of 20-year-olds together, and we spent a lot of time in Silicon Valley, and we launched things like online statements, and people went, what are you talking about? Why would I take a statement that wasn't delivered by the U.S. mail? And so a lot of things that we did back then were envisioning the future that is now just normal for people. Or tap and go. The first tap and go that we did was actually a sticker on the phone because the phones couldn't handle an actual tap. So we were just being really creative back then, envisioning this world. And to see it actually happen it's beautiful to see how it has enhanced access for so many more people to participate in banking. You used to have to go to a bank, by the way. You had to banking hours, right? They were 9 to 3, and they weren't in all the neighborhoods. And so both in the U.S. and globally, we now have a new relationship with moving money around the world instantaneously. So I'm really proud of that work.
Well, what's the role of stable coins in that, particularly with regards to moving around money? I was sort of thinking about, obviously, the Genius Act, which passed about almost a year ago from where we stand. And I know there's the Clarity Act working its way right now through Congress. But now you're sort of setting up the regulatory guardrails, legislative guardrails here. Does that benefit sort of the traditional banks in that space, or is that going to favor more kind of the newcomers, sort of the real sort of fintech forward type of companies?
So I'm a big believer in stable coins. I've been a believer for the last decade. I always thought crypto and blockchain were all upside opportunity. It was the safest way. It was the most secure. And the opportunity, so we have how many currencies in the world? And how many currencies, like the Peruvian sol, who knows about the Peruvian sol? But there's folks in Peru who need to conduct commerce, right? And so the idea of a stable coin has always, for me, been a safe way to instantaneously go in and out of multiple currencies. And, the FX traders are probably not happy to hear this, but I do think it democratizes the idea of commerce, international commerce, moving across borders with safety and security instantaneously.
Do you think the central banks, though, are going to stand by and, not necessarily allow it to happen, but not necessarily try to compete on their own with their own version?
They absolutely should. I've been talking to regulators for a long time about the fact that we should have the central banks have an opportunity to take the leadership position. Things are happening with outside of the central banking system. I'm a big believer, I grew up in banking, I'm a big believer that we need the participation of the regulators, we need the participation of the legislation to make it safer and to make more people feel comfortable with it. But this is the world, we're in a digital world already. And so having digital commerce, stable coins is absolutely crucial to digital commerce.
When do we start to get, though, more, transactional volume? I was taking a look. In terms of the actual total sort of raw volume that you're seeing out there, it's in the trillions, $30+ trillion with the stable coins. But when I was looking specifically at the numbers for what was actual payment activity, that was still around $400 billion. So that's a huge gap.
It's a huge
gap.
So
money's moving. But when do we start to see it moving more on the transactional side?
I think adoption curves, as you know, if you've been following this world of financial services and digital payments for a long time, and it always kind of starts slowly. You're talking about people's money. You're talking about their security. You're talking about their ability to buy a house, to send their kids to school. These are really important things, and they shouldn't move too fast, quite frankly. But I think the infrastructure does have to exist first. The early adopters are showing us what's possible. And now I do feel that we're at this cusp where people are really saying, I get it, I understand it, I want to participate in it. Not everybody knows how to do it safely, but most of the major, either wealth managers, 5 years ago, you couldn't go to Fidelity and buy crypto. You can today. Yeah. And I think that's where we're going with stable coins as well, with international commerce.
Can you give me an example of maybe what you think sort of the first sort of mass consumer use case will be, where we really start to see that?
I personally think it is around with stable coins. You don't need stable coins so much in the domestic market, right? We have a currency. I send you a Venmo or I send you PayPal. You know it's going to your account. But when you start thinking about how small businesses who want to open up to other markets, sell in other markets, buying things across border. I do think the borders are falling down in some ways where people are trying to participate in a global economy. And I think that's the major use case, where you agree on a stable coin so you can go in and out of the currency without taking FX risk.
It was interesting, too, the investor interest in fintechs has shifted a lot, particularly in private markets.
Absolutely.
I mean, it seemed like for a while there was kind of this reticence, maybe because of some of the regulatory and legislative issues. That seems to have been removed. You're seeing a lot more private equity activity.
Absolutely.
Obviously, a lot more activity in public markets as well. That continues?
We're a big believer. I mean, Advent, I obviously I'm the operating partner for fintech, so I'm probably not surprisingly going to say this is an area, payments and banking. I said a few years ago, all banks are fintech companies, and all fintech companies are offering banking services. So that hard line is really blurring. And if you are not a bank that is absolutely digitized and embracing all of this technology, you're not going to be here in 10 years.
Do you anticipate that maybe we'll see a bit of consolidation in this space with maybe some of the larger banks and larger institutions looking to these fintechs? Do you think that's
We
coming?
have to, because first of all, there's been 1,000 flowers blooming. It's been great to see all of this creativity. But now I think we are getting to a point where people are understanding financial technology, which includes the banks, which includes the payment processors, which includes the digital neobanks. All of these are all around making money move in a more seamless, secure way. And so I do think you're going to see consolidation, and I think that consolidation is going to be a good maturing of the industry, quite frankly.
In your role leading the digital business over at Advent, you're an advisor for a company called Shift Technology.
Yes.
Insurance, an AI.
It's an AI company, yes.
What does that mean?
So Shift is a company we're really excited about. I'm personally excited about. So they are a company that uses generative, predictive, and agentic AI to serve the insurance industry. They started with fraud, but now they have moved into all different areas of insurance. What I think is so exciting is you've got a company who you have 800 data scientists who are all specialists in AI and agentic, serving these more traditional companies as they get up to speed. So agentic AI right now, Shift, their biggest use case, and they've got 70% of the big insurers of the market out there, they can identify fraud because they're processing things at such a speed and with such an amount of data that just the old models were not as effective at. So I think that's the opportunity. AI, especially agentic AI, is not just about identifying the trends, which is what we all were doing in banking. Oh, there's a trend there. It's acting on it. It's stopping it. It's saying, wait a minute, I see a pattern recognition using all of this information. So I think there's going to be more and more specialization in artificial intelligence versus the more generalization chatbots where you're actually solving an industry's problem.
Is that technology, is it reliable enough for an insurance company to depend on, whether it's detecting fraud or underwriting or whatever?
I think that it has been proven that it is absolutely, not only is it reliable, identifies fraud that the current models wouldn't because of the scope of the data and the models. So I think as we move into different use cases, all of these things have to be proven. And Shift's been around for 10 years, right? And worked with the largest insurance companies in the world. So you definitely need, listen, I do not think AI is the solution for all all things that are going on. But I do think it can be an incredibly useful tool because of the comprehensiveness of its data sets and the way the models are now working together. You have agents talking to agents now. And we're just in a really exciting time. But it's like back when we said, will people ever receive their statements digitally? No, I want it in the U.S. mail. Well, nobody wants it in the U.S. mail now. And so I think we're at the beginning of that, and that's kind of exciting to be back again at the dawn of something new.
And that was Romain Bostic speaking with Kahina Van Dyke, Advent International Operating Partner. And be sure to tune in tomorrow when we bring you Romain's conversations with former Walgreens Boots Alliance CEO Roz Brewer, as well as Revolution Managing Partner David Hall. All of that coming up in the next day. Taking a look at how markets closed on this Monday, it was just last week that the S&P 500 closed at a record high, but since then it feels like things have really slowed down. We're in the middle of August. I know we have some retail earnings that are coming up and the Fed minutes on Wednesday, but people are just kind of, it feels very much like people have looked at August and they were like, all right, we're on hold for a while now.
Yes, it does feel like ghost town. Romaine said last week that we were the only two people in the building, and now I think it's you and me, the only people in the building, Scarlett, and of course our great team who help us produce this show. But I think it's really because of the geopolitical news. I mean, you see oil prices elevated because, I mean, I think it's really just concerns about whether inflation will again be worse because of energy prices, and there's dimming hopes that there is a deal to end the war in Iran.
Yeah, Brent topping $90 a barrel. You could see WTI approaching $85 a barrel. And of course, yields, especially at the long end of the yield curve, moving higher. But it's not just the U.S., it is around the globe. This is The Close on Bloomberg. Retail analysts are preparing for a busy week with big box stores, including Home Depot and Lowe's, set to deliver earnings along with a read on the consumer. Lindsay Dutch is a senior analyst in consumer hardlines and beauty with Bloomberg Intelligence, and she joins us now with more. So, Lindsay, when we look at earnings out of a Home Depot or Lowe's, how will that differ from other consumer companies? I feel like there's a lot of focus on the weather when it comes to these two kinds of names.
Yeah, hi, Scarlett. Thanks for having me. I think the main difference when we think about the second quarter, is Home Depot's exposure to the professional contractor market. Half their business really comes from pros. They're making a bigger push with those contractors to spend more with them. And while we continue to see pressure on consumers, which we will see through earnings from some of the other retailers, Home Depot does have that offset, and those pros have really high ticket values as well. So a higher ticket from those pros can really offset sort of even declines in transactions and pressures on the consumer.
So Home Depot, Lindsay, is facing higher operating costs. How much longer can it protect margins when sales remain weak?
Yeah, so costs are rising. Home Depot has filed for tariff refunds that could offer, some, one-time benefit. They're also, working on some M&A integration as they do a bigger push with the professional contractors, and that's also weighing on profitability. So I think there's multiple levers going on, and they're working really hard to cut costs where they can and increase that margin profile as time goes on.
So Home Depot reports tomorrow. Lowe's reports on the 19th, so the day after that. It feels like Lowe's, in some ways, has kind of mimicked Home Depot's strategy by going after the professional contractors.
Yeah, that's correct. Lowe's does still have more exposure to consumers. When we look at, expectations for the quarter, both of them are sort of expecting, maybe a modest, sequential improvement in same-store sales growth, really coming from those pros. But when we look at the overall picture, Lowe's has more exposure to DIY consumers. And so any pressure on that consumer, we saw Tractor Supply earlier, miss sales and earnings. Lowe's has more exposure to that risk.
What are you most keen to hear tomorrow when it comes to Home Depot earnings? Are you thinking of whether it's the consumer sentiment? Are we going to see a weaker consumer or a stronger consumer? Maybe they're going to cut their outlook?
So I think that second quarter so far, when we think about the housing market, which is a dominant driver for these results, there's not a significant change from first quarter. Affordability is still a problem. Housing turnover is still low. So we still sort of expect, those dynamics to be playing through that second quarter. Pro spending is expected to exceed consumer. I would expect that trend, to come through earnings, and we'll have to see on the guide. I think there is a lot of uncertainty on the consumer, on demand going into that super important second half of the year. But we have to see, what came through in the second quarter. Tractor had a really weak month in May, so we will be on the lookout for that. And if we think about a Somni Group, they sell bedding. They said that the July 4th sales were very, very weak. So I think a better understanding on what happened, in the months of the quarter will give us a better idea.
And just very quickly, Lindsay, you mentioned tractors, you mentioned bedding. We also know that Whirlpool, for instance, is a supplier to Home Depot as well. What can companies like that tell us about how Home Depot is positioned?
Right. So appliances, the appliance category has been very weak. I also cover Best Buy. That has been a challenge for Best Buy as well. Lowe's really stands out with appliances. They have a unique proposition where, they can really get that delivery when you have an emergency with the appliance. I think that's one, that similar to Somni Group, July 4th sales would be really key in that category. And we have to see if that was maybe enough to fuel some growth. But the outlook was very weak for this year.
Lindsay, thank you so much for those insights. That was Lindsay Dutch, Bloomberg Intelligence Senior Analyst. Let's stick with the retail space and take a look at Home Depot, which is set to report before the bell tomorrow, Tuesday. The big box retailer has struggled in 2026, with shares still in the red year to date. You see the stock there down by 2%. Let's bring in Stephen Zaccone, a retailing and hardlines analyst at Citi. Stephen, you have a buy rating on Home Depot. Any expectations for tomorrow when they report?
Yeah, thanks for having me on. Expectation for us, slightly positive comp for Home Depot, slight beat on sales and earnings. Reiteration of the year. The story in home improvement has definitely been a waiting game for housing turnover to improve, right? You'd like to see that large project activity come back. That's really the opportunity as you look on the multi-year horizon, but right now, slight beat is the expectation for us from Home Depot.
If rates stay higher for longer, is that a problem for your $400 price target for the stock?
I wouldn't say so. We've seen engagement in the category come back now for the last year. It's really from the existing homeowner. So you're doing projects at the home. What's really missing is the turnover component, right? We can see the existing home sales metric has been bouncing along the bottom for a couple of years. Mortgage rates are stubbornly high. You're waiting for that improvement. It's actually been encouraging this year that you've seen pretty stable trends despite rates hitting one-year highs, right, amidst all the geopolitical conflict and higher oil prices. So it's actually been encouraging. Things have hung in. So I think it can hit it. I think you're buying Home Depot for a multi-year improvement, right? We've seen 3 to 4 years now of negative comps. We're at the point that the industry is bottoming, and you're looking for a 2 to 3 year improvement from here.
Is a name like Home Depot vulnerable to activist investors coming in, Stephen?
I wouldn't say so. I think they've made some good strategic decisions, right? Like they've been going after the dollar opportunity with that larger pro. They did the SRS acquisition. They've done the GMS acquisition. They did another HVAC acquisition this year. They're really going after the dollar opportunity. They're not as focused on the margin rate as they were pre-pandemic. Now it's really going after the dollars, and I think that's the right strategy longer term. Obviously we're hoping for a better housing market. That would be icing on the cake, but I don't think anything strategically has been poorly done here at Home Depot.
In terms of weather, Home Depot is one of those companies that actually benefit when there's disruptive weather, whether it's storms in the wintertime with snowstorms or big hurricanes as well during the late summer and early fall.
Yep.
What does that, so far this summer it's been fairly quiet. What does the comp period look like?
Yeah, good question. The compares are easier, right? So we didn't really have any named storms last year, and that's an opportunity as you think about 2026 in the back half here. It's more important for Home Depot because the SRS business that they acquired has a big roofing presence, and roofing has been challenged. So that's really the easiest comparison. So, you're not rooting for storms, but you're rooting for a more normal environment that would be favorable for Home Depot. Lowe's would stand to benefit as well.
What about tariffs? I feel like that has slipped to the sidelines for a while. Are they ultimately a margin problem for Home Depot? Until when can they push those costs through the consumers?
Yeah, they've been able to. So pricing on average has been up about 3% for the last couple of quarters. That's the expectation we have here in the second quarter. When you think about tariffs, they're actually going to benefit from a tariff refund, right? They haven't disclosed the amount, but when you think about use of proceeds, right, optimizing cost and price is really key. So they've been able to kind of handle the tariff pressure. Obviously, they're a big organization; they can negotiate with their vendors, right? They've been able to pass that on. I think that's the continuation of that trend going forward for the next couple of quarters.
I'm so glad you bring up the tariff refunds. That's a tailwind, but for how long is that a tailwind, really?
Yeah, good question. Depends on your industry, right? So I think when you look at a Home Depot and a Lowe's home improvement, you typically have a rational industry. Yes, there's events that we can talk about like July 4th or Memorial Day weekend, but it's not really a promotional driven purchase. I think in other areas of retail, right, like a grocery, we'd be very focused to hear what some of the big mass players say this week about reinvesting some of the tariff refunds. That's where it can get a lot more promotional and competitive, right? Like you got to be sharp on price there. I think in home improvement, not as much.
Gotcha. All right, Stephen, really appreciate your joining us today. Stephen Zaccone, Citi's retailing and hardlines analyst ahead of Home Depot's results tomorrow. Still ahead on The Close, what investors need to watch for over the next 24 hours. We've got a preview for you. This is The Close on Bloomberg. All right, it is Monday afternoon. Let's look ahead to what else we're watching over the next 24 hours. In terms of earnings, Home Depot will be reporting. We'll be all over that. Baidu reports in Beijing on Tuesday night, so that's Tuesday morning, our time. Amerisports, which owns Arc'teryx and Solomon, they'll be reporting results
fancy
as
brands.
well. Yes, fancy brands, exactly. Do you go skiing?
No, I've tried 3 times in my life, and I vow never to do it again. What about you?
I try to, but you don't have to be a skier to wear Arc'teryx.
That's true.
We also have eco data, import-export prices, housing starts, building permits, industrial production, and pending home sales. So a read on the housing market, especially with the Home Depot results coming up.
And tomorrow we have congressional primary elections in Alaska, Florida, and Wyoming. I mean, can you believe it? It's almost here again. And tomorrow we also have Bloomberg New Voices live still in Martha's Vineyard. I'm really jealous. Romaine Bostick is there.
Yeah, he said the weather was not so great today. It's supposed to clear up. And of course, we'll be checking in with his conversations. That does it for us. Balance of Power is up next in Washington. Have a great evening, everyone. This is Bloomberg.